What is Wall Street missing right now?
Ultimately, it does come down in a big crash. It's a black swan. It's more of a virus that is infecting throughout the entire economic body. The Fed is going to have to resort to substantial money printing. The political class, the political elites, what some people call the Epstein class, that control our politicians. The biggest lie is that you can have a sustainable, growth-oriented economic system without a sound monetary system. They do so at the peril of human civilization.
Hey everyone, this podcast is not investment advice, and I'm certainly not a financial advisor. Just a guy who spends too much time reading about markets. Before investing, do your own research, talk to a licensed advisor, and remember, risk is part of the game. All right, welcome back to another pod. If the stock market's looking pretty resilient to you, Dr. Mark Thornton says you might want to be careful. Because what looks like strength may actually be distortion, a synthetic boom built on intervention, bad incentives, and pain that has been delayed, not removed. Thornton is a senior fellow at the Mises Institute and one of the leading voices in Austrian economics. He argues that when governments and central banks keep stepping in with cheap money, liquidity, and runaway deficits, they do not remove the pain. They shift it, hide it, and push it further down the road. If he is right, this certainly isn't healthy growth. It is a system being held together in ways that make the eventual reckoning much more severe. Mark, welcome to the pod.
Aaron, it's great to be here with you today.
Pleasure to have you. So, inflation is heating up again. Private credit is certainly starting to crack, and a major energy shock is now in play. Yet the markets, to me, are still acting like everything is relatively fine. What is Wall Street missing right now?
One of the main parts of the Austrian business cycle theory is that those lower rates and that expansion of credit forces loans and credit into the hands of less worthy borrowers. And for people who are going to be investing in riskier, more high-tech, more speculative type of investments, and that creates a very fragile financial structure throughout the economy. So banks, credit card companies, any kind of lending institution on the one side has a fragile capital structure. And then on the real side of the economy, with investors, companies, corporations, they're, investing in all sorts of things based on the market signal that they're receiving, which is the interest rate and the availability of credit that tells them to borrow more, and invest over longer periods of time. And so people tend to get into very speculative, high-tech type investments. But of course, the reality is that the economy's not built for that extreme in the financial sector. And ultimately, we all pay the price in the form of a breakdown of that capital structure. And as a consequence, we end up with a bust in the business cycle.
Let's talk about that a bit more, because our viewers know I've been rather nervous about equities for probably half a year now. But one challenge I have is if the last 15 years of market strength were built on, let's call it artificial support, cheap money, basically. What finally exposes that? When is this house of cards going to come crumbling down? Because it seems like they can just keep papering over any mistakes or any slowdowns that happen in the economy.
Well, and indeed, that's what they've been doing. And there have been minor bouts of this high-tech investment, like in the streaming services after COVID. They came and they went. They got built up beyond any usefulness, and then they all crashed. So it's not just a linear process, but ultimately it does come down in a big crash. Now you say, what kicks this off? Well, very much like other people, it's a black swan. A black swan that comes out of nowhere and it appears and it's a problem, and then all of a sudden there's all sorts of contagion. And I spend a lot of time trying to identify potential black swans, things like private equity, private credit, uh, artificial intelligence, are some of the leading candidates. But notice that black swan has a contagion effect throughout the economy, so that it indicates it wasn't just mistakes isolated into one sliver of the economy, but it was the same sort of mistakes that were built into the economy really throughout the high tech and high capitalization areas of the economy. The central bank is sending the wrong signals to everybody in the form of an artificially low interest rate. And so it permeates the entire economy.
You were early on in the calling out the private equity and private credit risk. I think long before most people were talking about it. Why did that market stand out to you? And there's a lot of rhetoric around it in some of the headlines now, but why did the private equity, private credit market stand out to you, and how could a problem there kind of spill into the broader financial system? Do you think it's big enough to take down this market?
Well, it's a great question. I am so glad that somebody finally asked me that question. And so one of my colleagues in the Austrian school has called these things, and he goes back in history to the Great Depression and has found what he calls sequestered capital. Okay, and sequestered capital is kind of fenced off from the marketplace. It's not exposed to our daily observations. It's not really revealed in regular reporting and things of that nature. And that's exactly what private credit, I'd frankly, private credit is not something that everybody's all that familiar with. It's only this year when the government tried to relax the rules to allow individuals to own private equity and get involved in private credit directly. It was actually not permitted, and so because it was recognized as being, twice removed from the typical parameters of market performance. And so it's not surprising that if the Fed is, gushing all this money in and banks are unleashing all this credit at low interest rates, they have to do it to less desirable, less credit-worthy borrowers. And so they tend to emerge in these sequestered environments. And just like the housing bubble, where all of the costs, which were ultimately borne by the taxpayer, ended up in derivatives and mortgage-backed security and credit default swaps and, the litany of sequestered investments that emerged at that time. Well, and then, if we go back even further, it was junk bonds. And, but nowadays, I think, from my observation and from my listening to a lot of smart people out there, private equity and private credit seem to be a classic case of this sequestered investments where we don't really have a lot of hands-on information. And but the information we do have that's starting to emerge is, well, things aren't working out exactly according to plan, and we're going to plan B over here and plan C over there, and we're going to have to refinance this stuff somehow. And then, of course, in November, and the Fed announced that it was going to have to start buying government bonds. And it started that program, I think, in mid-December. And they said, this is not, monetary policy, and this is not quantitative easing. This is just for liquidity issues that are currently in the market. But of course, that's what they were looking at, is the liquidity problem with private equity and probably also commercial real estate as well. And so they wanted to provide more liquidity so that the commercial real estate loans and the private equity, private credit situation would have a little bit more breathing room.
Do you think it's big enough, private credit and private equity? Do you think it's a big enough? I think it's a $3 trillion market right now. Is it big enough to take down the broader stock market?
That's the figure that I've heard as well. But remember, this is an issue of contagion. It's not one isolated problem. It's not a broken arm that can be fixed and then everything works well. It's more of a virus that is infecting throughout the entire economic body. And it works itself down into consumers as well. Now, consumers aren't investing in high tech and long-term capital directly, but they are adversely affected in the same way. So this is a contagious problem when it's created by the Federal Reserve. And so, like those banks that went under a couple of years ago, like the credit default swaps in the housing bubble, the smaller single issues quickly spread throughout the economy. So no, private equity and private credit are not big enough to destroy the entire economy. The entire economy is 15 or more times larger, and even if private equity and private credit were to completely melt down, it's not all bad stuff. I mean, there's plenty of viable investment vehicles within that sector. So in and of itself, no, but it's representative. It's the black swan, I think, or at least it's a good candidate to be the black swan, but it's also part of this whole contagious factor that the Fed has unleashed. And, the Fed, in addition to its policies of keeping the market alive, I mean, it just hasn't allowed much in the way of cleaning up the mal investments that have been made. And, of course, this expansion in markets, I think if we looked at the S&P 500 and NASDAQ, I think they're like going on 15, 16 years of expansion, which I'm not sure really if I can remember stock markets expanding without some contraction, some, negative periods where it qualifies as a crash in the economy, not necessarily a stock market specific crash, but where stocks eventually lose 25% or more of their value, and the economy goes into a sustained recession. And we really haven't had that. We were probably going into that in 2020, and I was predicting that might have been a time period based on my skyscraper index, that 2020 was a time of reckoning. But of course, miraculously, instead of a black swan, we had the COVID virus, and the Fed printed up $5 trillion, and the Treasury borrowed another $5 trillion, and that seemed to cover up the problems that were emerging in 2019 and in early 2020. And so we had a teeny recession. We had a very sharp, but almost not very long lasting at all correction in the stock market, and everything got reflated. And central banks do have some possibility to reflate these things. But of course, if they lose the confidence of markets, or if markets overwhelm the abilities of the Fed, there's nothing they can do to stop it. But sometimes they can.
I think, this has been a historic bull market. I don't really count. Some people say, "Oh, COVID created a bear market," but it was so short-lived. It wasn't It didn't have the psychological impact on investors that a typical bear market would, which brings about caution and more focus on value investing. I think we've created an environment where over 15 years where everybody just believes buy the dip, buy the dip. Going back to kind of this 15-year bull market, and it started really with the onset of QE with Bernanke. If markets really do start to break, let's say this year or soon, aren't we just heading into another major round of money printing?
Yes. The skyscraper curse, I felt, was going to reveal itself late in this year. And I anticipate, that for actual on the ground financial structure reasons, that we could see the cracks being revealed later this year, in the economy, in, private credit, private equity, and in the financial stocks. And then that would, that's something that the Fed would respond to. I think the Fed is keeping an eye on those conditions very carefully. I don't think Chairman Powell wants to get involved at this point, but I think that they will act if they see anything that's eminently going to break in the financial area. That's really, they're bankers, and they're supposed to be monitoring the banks. That's their responsibility. And so they're going to respond to that first and foremost. And they know better than anybody that they make banking and finance systematically or systemically unstable. So they know it's a problem. And I think that, as these stories develop throughout the rest of the year, it's going to become increasingly obvious that the Fed is going to have to resort to substantial money printing, easing credit conditions, quantitative easing. Their hands are tied in some respects because of the situation between the dollar as a currency, value worldwide, and the federal debt market. They've got to be concerned about the price of government bonds going forward. The U.S. government bond is not surprisingly looking pretty sickly right now, and they don't want that to get any worse. But they may be in a position where they have to become, and they already are. I mean, the recent Treasury auctions, the government had to buy up most of the auction itself. So, that market is not looking very good. And so the Fed may have to become what the Bank of Japan has been these many years, which is, one of the primary buyers of government debt, which means monetization, which means that that's going to circulate back through the economy in the form of higher prices, probably faster than we're used to. So, yeah, I think that is the path that we're on right now.
Doesn't that just create more of a risk on environment for investors? In such a scenario, people would want to get out of cash and just put it into assets that can generate a return. Doesn't that just create a bigger and bigger and bigger bubble? In a world of rising deficits, currency dilution, and market volatility, many U.S. investors are choosing to diversify their retirement accounts with assets like physical gold, silver, and even crypto. This video is sponsored by iTrust Capital, which offers a platform for Americans to hold physical gold and silver, as well as crypto, directly inside a tax-advantaged IRA. Designed around transparent pricing with clear premiums over spot and no hidden storage fees, iTrust Capital offers something that still isn't standard in the precious metals IRA space. So if you're a U.S. investor looking to learn more about owning gold, silver, or crypto inside an IRA, use the link in this video description. Americans may be eligible for a $100 funding bonus when opening and funding an account with iTrust Capital.
Yeah, in a nominal sense, sure. Look what it did for Venezuela. I mean, the Venezuela stock market,
Crazy.
if you were just to look at the graph, it looked great.
Yeah.
It was shooting higher and faster and longer than any other stock market that I'm familiar with, at least. But it was all driven by a hyper sort of inflationary scenario in the domestic economy. So yeah, I mean that's what happens as you move from a subtle inflation to a strong and then eventually a hyperinflation. Any real goods, any real assets that can be financially sustained through tough economic times, because of course the inflationary process eats away at economic substance, discouraging savings and discouraging work and, all sorts of things. And people are, more into non-economic activities. And so the real economy is going to be sickly. And so a lot of assets are not going to be quite as sustainable through that process. So, it's a harrowing sort of look. Certainly, we don't hope that happens. What needs to happen to prevent that is, of course, sound money, stable money, balanced budgets, and all of those things. But unfortunately, our political class seems to be thoroughly uninterested in the basic methods and remedies of economic success. Nobody's really talking about it, which is the thing that worries me, that nobody's, even if they voice concern in Washington or at the Fed, politicians, world leaders, they never really say, well, we must cut spending and we must balance the budget. Those words never come out from the political elite class. So that's what's worried me. And I think I would be reassured if I started hearing, the socialists in Europe, recanting their positions. If the U.S. and Canada, turned around and got rid of their socialistic governments and politicians hunkered down and tried to do something about they're the ones that are creating the problem. They're the average citizen. We can't really reach in and solve this ourselves. The political system is creating this festering of enormous economic waste and enormous misallocation of resources through the Fed. So that's where it's got to take place. And I think you would want to see signals out of that sector.
The problem is Keynesians run the world, right? Austrians, I mean, look, it sounds great. It obviously would be the most honest way of running economies, but Keynesians run the world. I think they believe, and politicians are of the same ilk. They just believe we can keep printing. We've created these monetary tools that have worked for the last 50 years. I don't really see this changing. It especially not the endless deficits and so forth. Nobody has the political will or political capital to get in the way of that. Do you see any possibility of that happening, where we're going to get some sort of world leader or perhaps a president in the U.S. that says, nope, we have to go back to balanced budgets? I just can't see that happening. It would require too much pain in the short term.
No, I don't. The political class, the political elites, what some people call the Epstein class, that control our politicians, and so they control our government and many governments around the world. as well. Obviously, the American people have tried to influence their government. Voting in President Trump, that didn't turn out the way everybody had hoped. But this Epstein class, they benefit tremendously from the system. The average American, the average citizen, the working class America does not benefit. They're harmed as a result of this system. So this class wants to continue the system. They want to continue kicking the can down the road because they actually make money. They actually get more money and more power and more wealth from this kicking the can down the road. So they're always going to go for that.
Given all that's going on right now, the potential of a black swan or contagion from one event spreading throughout the economy, how should one prepare today? What should investors be looking to do at this exact moment?
Well, of course, I'm not a financial advisor, but I have done episodes on my own Minor Issues podcast where I look at investment themes. And I've had one on inflation. I've had many on inflation. I've had a couple actually on hyperinflation and what that means and how to sort of prepare for that. That's somewhat down the road, but I think a couple of things that are baked into the cake that I've looked at quite extensively is that based on trends and previous investments and policies, I did a podcast on the positive outlook for commodities and commodity stocks in the future, 10, 15 years out into the future relative to the past. And because the investment that's taken place over the last 10 or 15 years has not been in commodities, it's been in technology. And so a lot of the investment dollars have gone into technology. So we would expect, just not on the basis of economics or financial stock analysis, but just on a general return to the norm, that commodities and underinvested commodities and commodity stocks would do well in energy over the next long period of time, and technology-oriented stocks would do less well over the next 10, 15 years. So I put out that basic thing, not making specific recommendations, but just a general analysis where commodities and commodity stocks should do better as of, I think that was in 2024 and 2025. I talked about that. And then in 2025 and 2026, in 2024 as well, I developed the idea that the long-term downtrend in interest rates was probably over, that we saw from 1980 until 2024, that there was a long-term downtrend in interest rates. So that, yes, there's squiggles in interest rates, on our short-term charts, but on the long-term chart, there was this great, giant, multi-decade down decline in interest rates. And as of a year or so ago, I think that downtrend has been broken, and I believe that we will see over the long-term period higher and higher interest rates in the U.S. and world economy, and this would have negative implications on investments in bonds. And again, that's a very generic, I wasn't picking bonds or particular countries' bonds or anything like that, but just that over an extended period of time, a decade or more, that interest rates will be rising and that bond prices will be falling, and probably that will have a dampening effect on stock investments as well. As you put that into your valuation models, of course, those higher interest rates lead to a lower valuation of stocks, particularly at the high end, higher risk type stocks. And so, those are two things outside of the direct analysis of the business cycle, which is of course, it's a multi-year period thing, but it's probably only a few years in the making, not decades or more. So, I think that's what forms my my general outlook for the world economy. And so far, of course, I basically have been, I can't say I recommend things because of I'm in a nonprofit and, I'm not a financial analyst. I'm not a personal financial advisor. So I don't recommend investments, but I talk about I analyze them, cast a pretty clear positive or negative signal. And right from the very beginning of my podcast, I started talking very favorably about gold and silver. And of course, they've done extremely well over the last few years. And there's a lot of reasons for that. I mean, with respect to gold, which is the leader, central banks have been, a big part of the demand for gold. But the fact that central banks no longer trust other central banks, I think is a bad sign.
Mm-hmm. It's interesting when you talk about a rising rate environment. Doesn't that just speed up the process of a inevitable U.S. government default? Like how would they, in a rising rate environment, how does America survive? I mean, I think it's already I don't know what the number is. It's around $1 trillion a year in interest payments right now. It's effectively the same size as the defense budget. How does the U.S. government continue on this path? I mean, something's got to give if we're headed for a higher rate environment, no? In a world of rising deficits, currency dilution, and market volatility, many U.S. investors are choosing to diversify their retirement accounts with assets like physical gold, silver, and even crypto. This video is sponsored by iTrust Capital, which offers a platform for Americans to hold physical gold and silver, as well as crypto, directly inside a tax-advantaged IRA. Designed around transparent pricing with clear premiums over spot and no hidden storage fees, iTrust Capital offers something that still isn't standard in the precious metals IRA space. So if you're a U.S. investor looking to learn more about owning gold, silver, or crypto inside an IRA, use the link in this video description. Americans may be eligible for a $100 funding bonus when opening and funding an account with iTrust Capital.
Well, you're definitely right. I mean, there's some kind of financial reckoning, but of course it's a political decision. And so it's not like in the private sector where we can look at somebody's balance sheet and, give a sort of a definitive choice set and a definitive timeline on things. As I said, this political class, I think they're in it for sucking every last drop of blood out of the American people. And, I think it's going to end really with some sort of political, resistance on the part of the American public. I think you can sort of see sympathy for that kind of thing. Clearly, the American public are very, very strongly against President Trump's involvement with Israel in the Middle East. Mm-hmm. And I think Americans are going to be sick and tired of that. And I think from that, you may get some kind of political movement asking itself, how do we solve the next big problem? because this is going to take, because it's going to be such a painful solution, it's going to take an American consensus, and it's going to take Americans looking at the issues and making a decision. It's not, you can't have a unilateral president coming in and saying, this is what we're going to do, because I think that would be generally unacceptable. And, the American people have allowed their government to be run for them rather than by them. And I think that's the big dividing line that has to be crossed, is that Americans can no longer allow government to be run for them. It has to be run by them. And because, of course, all of the solutions involve eliminating huge swaths of government involvement in the economy and in our lives. And that provides tremendous benefits. And it comes at a lot of costs. People are going to lose benefits. They're going to lose, various privileges from the government and various subsidies from the government and various, welfare handouts from the government. And in total, it's going to be a very painful adjustment. The only thing I can say is that the benefits on the other side of fixing the system are enormous, and the unwillingness to deal with these problems is simply going to multiply the negative effects that government is imposing on our daily lives.
What is the biggest economic lie that people are living through right now?
The biggest lie is that you can have a sustainable, fair, and balanced, growth-oriented economic system, the global economic system that ensures prosperity for all and economic growth forever, without a sound monetary system. And by sound monetary system, I'm talking about the system that developed in the marketplace almost before there were governments, and that's gold and silver money. And that's what really took us out of the Stone Age of a very primitive animalistic existence to the state that we're at right now up until 1971. We had a gold standard, which was a universal medium of exchange throughout the global economy. And look at what we were able to accomplish, that human being animals never could have accomplished and never did accomplish. That's the importance of it. And most economists don't understand that you have to have a market-oriented monetary system to ensure that you have a smooth working system. First of all, gold and silver hold their value over extended periods of time. And gold and silver force governments to balance their budget and to not get involved in treacherous spending programs or socialism generally, war. And it also is a monetary system which creates a great deal of equality amongst the various economic classes, entrepreneurs, capitalists, workers, etc. And it's that kind of, the harmony that is created amongst the economic classes, where the division of economic production is done in a fair way. I mean, it's based on economic value created, and and those societies tended to be very harmonious, and everybody was getting ahead, and then the bird brain Richard Nixon thought, well, we got to get rid of this system because we can't afford the Vietnam War. And look what's happened as a result ever since. More socialism, less harmony, more strife, more runaway government spending, war, etc. And of course, even protectionism more recently. But sound money based on a market-based system is something that everybody ignores, and they do so at their own peril. They do so at the peril of human civilization.
Mark, that is a great spot to wrap it up. Before I let you go, where can our viewers find you online and follow more of your commentary?
It's great to be with you here today. I had a great time, but I work at the Mises Institute, named after Ludwig von Mises, the great Austrian school economist who worked in the United States. Our webpage is one of the largest economic web pages in the world. It's mises.org. And we have articles and video and lectures, audio lectures. We have 4 or 5 podcasts that we put out every week, books, events, conferences, academic journals, book publishing. We do it all. And as a matter of fact, we're giving away a free book right now of F.A. Hayek's greatest hits articles.
Nice.
F.A. Hayek was a student of Ludwig von Mises. He was awarded the Nobel Prize in economics for extending Mises's business cycle theory. Incredible man, incredibly great thinker. And we have some of his best famous articles here. You can get the whole thing for free. One article in particular that he wrote was Why the Worst Get to the Top. Well worth reading in today's times.
I'm picking up a copy, and we will include links in the description. Mark, it was a pleasure. Thank you for your time.
Thank you, Aaron. It was great.